Ladies and gentlemen, I think it's time to get started. We have another full day today. I appreciate how sturdy an audience you were yesterday, and we had great questions and discussion. We're looking forward to a second day of that. Before I talk about our agenda for today, I want where our discussion went yesterday. Secretary Baker, of course, opened the conference talking about the importance of gas imports to the U.S. market and the need to understand how important globally gas is going to become and the geopolitics of new supply. Minister Atiyah joined us by video, and he outlined Qatar's plans to rapidly expand their participation in LNG markets, including new ventures to the U.S. with important joint venture partners and involvement in terminal development. He categorically stated that Qatar would not participate or did not anticipate the formation of a gas OPEC. And you might all see his picture on the screen in today's Houston Chronicle making that statement. And he outlined his interest in GTL technology. James Malva then laid out the importance of diversity of supply for buyers and spoke extensively about the need for clear permitting and access to terminals and the importance of receiving terminals in the LNG chain for ensuring steady supply into the United States and elsewhere. Ambassador Region also talked about the importance of security of supply, but emphasized gas's potential to help find new supplies for the 1 billion people in the planet that are without modern energy services. We heard from Dr. Khalil, the oil minister of Algeria, that gas is plentiful and available to meet the needs of the international community, but that contract provisions are best to ensure supplier protection against risks and buyer protection against risks. He said that a competition between suppliers or among buyers was not in anybody's interest, and that he used the example of the EU and the need for producers and consumers to have a cooperation and an important dialogue and not to take unilateral action. He asked for a more equitable cooperation, and he talked about the importance of taking into account producers' profits and risk sharing, and asked for a guarantee of equitable and fair prices for producers. We also heard during our plenary session excellent commentary from Peter Hughes and Philip Dingle, emphasizing that the industry needed to do a better job at building trust in the process and in the technology of LNG. They talked about their confidence in the safety of LNG and the need for a much more rational plan and regulatory environment for the siting of LNG facilities. And then in our panel sessions, Bruce Kiley of Baker and Botts noted that the United States has a very pro-LNG national policy, but that the siting of LNG receiving terminals remains a big challenge for the industry and for consumers. He talked about FERC's decision process and how their original rulemaking had created uncertainty, and that it was important to integrate producer trains and businesses or flows from suppliers together with terminals as part of a single project and not to consider them with the same regulatory structure as pipelines. And he talked a lot about the importance of having federal authority in the siting process and to streamline and cooperate in the state review process. This morning, we are going to open the day looking at the changing structure of the market. We will have some interesting presentations from our case studies on that subject, and also some model runs that are based on alternative scenarios to the base run that was discussed yesterday. And then we will move into our final session, which is about the future challenges to the gas vision and whether some of the more optimistic views of the future of gas, what could be the pitfalls and roadblocks to having that vision come to be. So with that, I turn my microphone over to our session chair.
Thank you, and good morning, everyone. After yesterday, I hope you have some level of attention left, because today may be as interesting, if not more. I understand I've been hired as the gatekeeper here, the timekeeper rather, so I'll do my very best to keep everyone honest and within time frame. That being said, it's an honor, and I thank Mark for having asked me to be your chairman this morning. I was not expecting it. It came in 2 days before I took my plane, so this will be impromptu and unprepared, but we'll try to make it fun anyways. Before going into it, I can't miss that opportunity to sort of express a little bit of a regret that, based on yesterday's content, the buyer's voice was very little heard of. The producer's voice was humongous, was hard not to hear. I just would like to tell you that companies like ours, we buy, consume, and resell in the neighborhood of 50 billion cubic meters a year. We are far from being alone. In Europe, Ruhrgas and Gaz de France are in the same area. In Japan, they are way bigger. And what we bring to this development effort in the LNG world is those 30 years of expertise and experience in developing, permitting, and operating terminals. I think it's very important, and we have, in every conversation we have with potential suppliers, we try to stress that the relationship we want to establish, or we hope to establish, is one of cooperation between producers and buyers, so as to make the value chain as transparent as possible. The nice part of a value chain is when there is value, so the first thing that counts is to create that value. Once that value is created, we can always argue on how to share it, but to try to argue about how to share it before having created is maybe much more difficult. Second element, because it is so important, the safety and security issue. It was covered abundantly yesterday. I don't think it is reasonable in this country to develop an important asset without the support of the local community or against the opposition of the local community. I think that's a pipe dream. This is still a democracy, and local governments, even when they don't have official right to interfere, have their own ways to interfere nevertheless. The issue we face is the scarecrow. LNG industry has had the good fortune of being essentially flawless in terms of safety and security for the last 25 years. Therefore, we have no example. We cannot tell what could go wrong because, to some extent, we don't know ourselves. And when we know, there is a strong tendency right now to say, when we know, we won't tell because that may give the bad guy a stupid idea. And so we are caught in that framework of, on the one hand, wanting to be honest with the people. And I think eventually we'll have to be honest with the people. It's the only way we are going to permit those sites. But at the same time, we are worried of giving weapons to those who want to harm us. That said, I've been in this business, in the LNG business, for 4 years now. For 4 years, I've been advocating for a unified effort to distribute and disseminate the knowledge. This is knowledge. LNG is not a nuclear bomb on an LNG carrier. It is less dangerous intrinsically than gasoline or fuel gas or aviation fuel. We have to get together, and today I see efforts coming, creeping here and there about improving the situation, but it's still a very disseminated effort, and I'm urging all of us in the industry, whether from academics, government, industry, to come together and develop a nationwide plan. That being said, thank you, Mark, for this opportunity. We're going to start with the study results. And Mark is the first one on, so I will leave him the floor.
Thank you, Philip, for that kind introduction. I think those are all very key points. So I'm going to start off this morning talking about a case study that I've been working on, looking at a time slice of Algeria in the 1970s and export projects to Europe that were considered during that time. My presentation is really the old world. This panel is supposed to be about changing market structure. And when I walk through the types of contracts and relationships, I think you can see that this was the old market for gas trade. And as we walk through the morning, James Ball is going to go second, and he's going to talk about the LNG project in Trinidad that really starts to really break the mold. And there's a lot of interconnections between the story that I'm going to tell and really creating the opportunity for Trinidad. And I think James is going to really follow up on mine. And then Ken Medlock is going to have our last study presentation for this session and look forward into the future and where we see the gas market going. So first, I just want to say I'm going to talk about gas pipelines from Algeria to Europe, and the logic for our research on these case studies is looking at a built project, which I'm going to talk about the Transmed pipeline that goes from Algeria to Italy, and compare that with a project that was not built during that period, and that'll be a pipeline that goes to Spain. I'm then going to talk about some of the things that happened after this pipeline was actually completed, and some of the long-term ramifications for Algeria. And as I said, James is going to kind of walk us through how that developed in the Atlantic Basin trade. To give you a geographical sense, here we have Algeria, and in the 1970s, this is the big play for gas resources in Algeria. It's the Hassi R'Mel field, known reserves at the time of 3 TCM, and that's of an order of magnitude that there's plenty of supply to go any direction they wanted to go. It's a question of, can you build a project to monetize the resource? I should point out that some people have asked, Insalal looks like it's really large down here. In terms of scale, it's smaller than Hassi R'Mel. It's just geographically a bunch of small fields scattered over a region there. We have pipelines proposed to go to Italy and to Spain, and I'll walk you through some of the details of that. I should say, again, in this kind of looking historically at the gas market, Algeria is the first mover. In 1964, they built the Arzew liquefaction facility at Arzew to ship LNG. The first commercial plant ships LNG to Canvey Island in the UK. So as a time slice, in 1975, right after the first oil shock, Spain is heavily exposed. They're importing virtually all the oil they're using. Oil's making up 75% of their primary energy supply. So there's an imperative for them to diversify away from oil. So gas is one alternative. They're really limited in other domestic energy resources. So they're looking to increase their gas supply, as is Italy at this time. So a kind of simplified chart, but to show you what the Algerians were thinking at the time as well. They had a lot of gas in the ground, and the administration that was in power in the 1970s were technocrats, and they had a vision of development, which was pump the fields until they're dry, and then we'll do something with that money afterwards. So these are very aggressive gas export plans in the 1970s. And I'll come back and talk about how this was actually realized and how it came out. So first I want to walk through the proposals on the Spanish side. Dating back even to the 1960s, there was a partnership between French and Spanish companies and Sonatrach, the Algerian gas company, to bring gas from Hassi R'Mel to Arzew, near Arzew on the Algerian coast, under the Mediterranean. It's a deep water line, 2,000 meters down. So this would have been completely at the technological envelope at the time, into Spain and then on to France. An alternative that began to be considered in the 1970s is what became the Maghreb-Europe pipeline. And that would transit Morocco, go underneath the Strait of Gibraltar, and into Spain. Gibraltar technically is an easier job. It's only about 500 meters of water there. But actually, both of these are tough jobs. Either of them would have been the deepest at the time. But in terms of relative order of magnitude, one may be kind of feasible with the technology. The Almeria route, direct route, was a stretch by any calculation. If you talk to people, even experts in the area, and ask them to look back at the 1970s and through the great 2020 vision of history, they'll say, well, it was impossible to go through Morocco in the 1970s. Algeria is basically at war with Morocco. And that tends to be a bit of a barrier to building a pipeline. So you're left really with the Almeria route. And there are a bunch of technical studies that showed that they suggested it was possible to do it. And you'll get different perspectives from people in the industry. Some will say, well, yeah, they didn't try, but other people would just laugh it off and say 2,000 meters at that time, no one had even done anything below what a diver could do. But I think more of the story is about the structure of the Spanish market and the complexity of the deal. Enagas, the Spanish state-owned gas company, doesn't have a lot of financial resources. It doesn't have the strong support of the state. And they have to partner with a French company to really create the market and make this thing happen. I should say also, that basically in the structure of the Spanish market at the time, there's other companies that have a lot more power. They're continuing to push oil even though they have to subsidize it heavily. As a result, you have lots of proposals for pipelines. You can skim through the trade press at the time, and every few months, things are out there saying, well, it's going to start in 77, 79. But in reality, nothing really ever happens on the ground. In 1975, under Franco, Enagas does sign a contract for LNG deliveries with Sonatrach in Algeria, around the order of 3 BCM per year. This is really the best evidence I can say from a kind of a counterfactual. They never took the full volumes underneath the LNG contract. Franco died in the end of 1975. There's all this policy uncertainty in the aftermath, transition to democracy. But if they can't mobilize the resources to build a gas grid in Spain to take the LNG deliveries of 3 BCM, it's pretty much infeasible to think that they could have built, I think what James has called yesterday the garden hose, which is a gas pipeline. Italy, like Spain, is largely dependent on imported oil in the mid-70s, so they're exposed to the same risk. There is a difference, though. This doesn't look like a very thick bar, but it's a domestic gas industry, and it's developing. Italy had the largest gas market in Europe, actually, in the mid-60s, something probably maybe people don't think too much about, and Eni was the largest producer. So Eni realizes there's this huge incentive also it's going to start looking afield for energy resources, and that's as a big company with a strong backing from the state. It's got a domestic gas network that's built up in the Po Valley in the north. It has the resources to go out and go to start to build a relationship with Algeria. Also, kind of the particulars of the politics. Mattei, as the very strong leader of Eni, is seeking out to build networks to places that the big oil companies can't go. For example, he's the first one to go to Moscow in the late 60s and sign an oil deal with the Soviet Union at a time that no one else really wanted to do it. So he's kind of going against the trend, and it's the same thing they're doing in Algeria. They're establishing warm relations with the Algerian regime that dated way back to their struggle for independence. So when it comes time to look for a gas pipeline, Eni is already on the ground there. As I've talked to some people, say there's people within Eni that had the Algerian bug. So this is kind of a natural place for them to look to bring in gas exports. 1973, actually, Eni and Sonatrach had already signed a contract, kind of a broader memorandum of understanding that they want to bring in gas. The question is how to do it. Within Eni, there's a debate whether they should bring in liquefied natural gas or pipeline from Algeria. Algeria is pushing ahead with LNG projects during this period, although they're having some problems with cost overruns, so they're interested in other options, but the resources are going to come from the Italian side. Eni Snam has a project partnered with Egypt at the time, and they're bringing LNG into the first regas facility in Panigaglia, but they're having a lot of technical problems with that. But I think more importantly within Eni, there's a strategic debate. They realize that they don't have a handle on the technology for LNG. There are other players out there that do, Total, Mobil. So there's this vision that we can establish ourselves and establish a real core competency in their engineering subcontractors or engineering subsidiaries, Cyprem and Snam-Progeti, that if they can do this pipeline, if they can push the envelope with the technology, they'll create a long-term niche in the field. And I think history bears out what a success story that was. They're a leader today, and cases like Blue Stream really bear that out. So 1977 is really when the first firm contract is signed for this project. They sign an agreement with Tunisia. It's a bit of a battle over transit fees, and I think this is an interesting point. Tunisia, when it looks like all the motions going ahead on the pipeline, Tunisia says, well, we'd like to take 12% of the gas that flows through. It's hard to see actually whether it's credible or not, or where the motivations were, but around the same time, Eni and Sonatrach say, well, maybe we want to go with an LNG project. I think that there's some rational actors in Tunisia at the time that say, well, maybe 5.25% is better than nothing at all, and they quickly back down. The project construction proceeds on. It's really a technological marvel. Eni is investing in some new technology. The contractors go ahead. In 1979, though, President Boumediene dies, and there's a big regime change in Algeria. Previously, it had been led by technocrats who are pushing that rapid gas export policy. The new regime that comes in really does an about-face. At the same time, you have the fall of the Shah in Iran. There's a change. They grab onto this perspective of, well, these are our national energy resources. We're going to hold back supply. It's going to be a price play rather than volume. We're going to do the same thing with gas that we did with oil. Somehow, I guess the construction just keeps going on its own logic. But in 1981, the project's actually completed. They're ready to start shipping gas. Around this time, the new leadership in Algiers, the new leadership of Sonatrach, says, we're not going to ship you gas unless you pay us 3x the price. Now, this is the same thing that Algeria and Sonatrach are doing with their major European buyers, and they pursue the same approach with the U.S., the contract they have with the U.S. What's known as the gas battle. It's a bloody mess, and countries like the U.S., forced by the DOA, just say, no, we're not going to take any shipments on these terms. It's kind of complicated. Belgium caves in. They accept the higher terms, thinking that maybe France and Italy are going to negotiate better and they'll be able to lower their price later on. The reverse actually happens. France accepts the terms, provides a political subsidy to cover the difference between the price that the Algerians were arguing for and the price that Gas de France thinks it can actually sell the gas for in its market. Once France signs on, Italy doesn't really have a choice either. It's trying to develop trade in other areas, industrial contracts in Algeria, and Algeria puts those on hold until the Transmed agreement is made in '83. So basically, the big difference that the Sonatrach was looking for is they're looking to index the gas to their oil exports at their border, freight on board. And they changed the agreement. This is a total change from previously where they were trying to price gas to compete in the end user market. And it looks great at the time in 1983 with high oil prices. The reality is that when oil prices go down, this contract formula that looks so great doesn't turn out so well. The price actually approaches zero or goes negative, but the Italians kind of have the foresight to bring it back to the negotiating table before the whole thing blows up. The gas shipments finally do start in '83. I've shown here the difference between the blue line, which are the contracted shipments in the 1977 agreement, and the purple bars, which are what actually flowed through the Transmed pipe. And you can see this is the no gas ships at all, and it's a slow startup, and it's very costly for Sonatrach. I mean, they have debt obligations to repay under the original agreement. Eni had financed, and Italy had financed the contract, so it's very costly on the front end from a net present value perspective. This is when they should have been earning all this is the front end earnings that are so critical, and this is all lost revenue. And if you just do a quick calculus, even at the 77 price, you see $3 billion in lost revenue. But I think the bigger picture, and I think James is going to give us a perspective on the long-term ramifications on Atlantic Basin trade, because it's that $3 billion calculation only touches the edge of the impact the long-term impact this has. But just from the Algerian perspective, this was the Valheed projections of rapid growth, and here's what they actually did. Their LNG trade basically caved in. The U.S. was the largest buyer previous to the gas battle. The U.S. doesn't take shipments and slowly starts to take more. They're somewhere in the middle of this bar. The European importers are now very concerned about security, and to this day think about things referencing back to the early 80s. So what does this project tell us? How does it tie back to some of the other case studies and things we touched on yesterday? As I said, for us, this is a project we think about as in the old world. It's critical, the role that the Italian government plays supporting Eni, backing the build-out of gas infrastructure in Italy that allows a large garden hose project to come on in Italy. I think you can contrast that with the kind of timid role, the inability to mobilize resources on the Spanish side. I think also there's a story about transit countries, as I talked about Tunisia. This is the contestability point. But I also think there's a story with the Transmed. Relations between Algeria and Tunisia weren't exactly easy at the time. The Tunisians made it a condition that the Sonatrach would have no role in the pipe that crossed their territory. But Eni is able to mobilize enough resources and say, well, okay, we'll buy gas at the Algeria-Tunisia border. We'll finance the whole pipeline through Tunisia and set up a structure such that there doesn't need to be this kind of cross-participation. And I think that's one story you can look at. And the same type of structure is pursued in the Maghreb pipeline when that actually does go through in the 1990s. And just in closing, I think we had this long discussion yesterday afternoon about this gas cartel. And I think before anyone thinks about withholding supply, they're definitely, if not definitely in the back of their minds, if not closer to the front, is the story about Algeria and really the long-term impacts on their sales. Thanks.
Mark, thanks for holding on to your 20 minutes. And very interesting presentation. It brings me lots of good memories way back when Belgium and Algeria were negotiating those gas deals that you were talking about. James, I understand you were robbed a few minutes yesterday, so you are going to continue talking to us about Atlantic LNG, and the floor is yours.
Thank you very much. First of all, I've got to do something that nobody's done so far this morning. Our chair is Philippe Van Mark from Tractebel. And that's why he was talking. That's why he was talking about the poor buyer that got neglected yesterday. And I take great exception to that because I tried to point out that this project that I was talking about is a project that was basically started by buyers, included buyers against the sacred cow views of the time, and it provided more flexibility than had been provided before. And since you're one of those buyers, I take even greater exception that you slept through my presentation. Right. Let me again tell you that I've got lots of nice ads on my paper on the site and go straight past them to what I'm going to do in agreement with Mark is first of all talk a little bit about market share for LNG in the Atlantic Basin historically. That saves him having to do it, and so it's sort of the bridge between our talks. First of all, though, since Mark and I have been talking about his presentation about our transition. There's just one thing. I'm quite big on gas history, and this thing about the pipeline to Spain is something that I know a lot about. So let me bore you for a minute, if I could. It was a Sagamo project, and in the 70s, it was technically feasible. I have seen the engineering study. In the engineer Bechtel had this huge study, and it was going to use the SEDCO 707. It was going to have JLA technology. Now, I doubt it was economically feasible. It was certainly physically feasible. But remember that that technology was not used to successfully lay a gas pipeline for another 20 years. So to go from where we were to 2,000 meters was simply a step too far, even if the project had made sense, which it didn't. But the 600 meters that Saipem then did on the Transmed was a huge step, and they built a purpose-built vessel for it. And I would argue that had they not taken that step, they wouldn't have also laid with the with the Saipem 7000, the Blue Stream pipeline, which was the first time that was actually done, almost 20 years later. So the other thing that is highly relevant to what David was saying yesterday, you don't lay pipelines in demand deserts. It just doesn't make sense. Now, some people will do it, but that pipeline at that time did not make sense. However, Medgas, which is being studied right now has the support of the Spanish government, is the exact same project. It now makes sense 30 years later. And it may very well take place, and it will be a lot cheaper relatively, probably even nominally, than it was then. So sorry for that diversion. What I'm going to talk about is the market structure in the Atlantic Basin. I just want to highlight, again, this point about context. We have a big shift in both the source of LNG and the diversity. And diversity is quite an important issue. It doesn't seem to be much of a concern in this country, but as you move from not thinking of yourself as an importer to being a real importer, you will, like all other importers, begin to understand the importance of diversity of supply as part of energy security. The other thing that I'm going to do, which was the main focus, the bit that I didn't do yesterday in my paper, is talk about how the actual project structure in Trinidad and Tobago evolved and how that contributed to the opening of LNG as a whole in the Atlantic. And basically the story is that buyer flexibility, which I argue was given in a way by accident by naive sellers partnering with buyers, turned out to be a lot better than was originally intended, and that begat seller flexibility. They decided, well, why shouldn't we be flexible amongst ourselves? And the flexibility in Atlantic trade resulted from that. They're the ones that broke open Atlantic trade into being flexible. And even today, you can see a total difference in the way patterns of trade in the Atlantic versus the Pacific. I know Pacific is twice as big, but nonetheless, the Pacific is also four times more rigid in their project structures. The first thing to say is that this is the prize. Let's not forget. You know, we talked a lot about these big markets yesterday. This is the biggie. And this is the largest gas market in the world. It's the largest single importer of gas. You know, people say, oh, it's Germany, it's something else. This is the biggest importer of gas in the world. And yet, it has the worst diversity of supply of any importer. There's no way that Germany would be happy to import 100% of their imports from one country. Yet the US goes off and lectures Germany about taking more than 30% from Russia. They take all their imports from one country. Now, where does LNG come along? Well, LNG is a lovely source of diversity. And you notice that the poor little LNG sellers, they only want a tiny sliver of the market. So go on, just lift the covers a little bit and let another one into the bed. This is the, but this is the prize that everyone's going for. Remember, however, that when we look at the collapse in the Algerian supply, it's around here. There was plenty of U.S. gas. There wasn't plenty of demand. So if you were going to get into that market, you had to be super competitive. Algeria chose, or rather a completely stupid minister. I think we should name Mr. Nabi, don't you? He at least can take blame, even if all of the people around him were now exonerate. Decided that that was a good time to raise their price and act tough. Playing hard to get when nobody wants you is not usually the best strategy. And this is what resulted. But then it picked up. And so remember that when we're talking about Trinidad and Nigeria targeting this market, we're here where it's picking back up. But if you look at this graph, basically those points and those points are about the same place. So U.S. production in 2000 finally reached where it was in 1980. And the demand was a lot higher, met by imports. So here's the prize. Now, the interesting thing is, you see, the LNG market has an Algerian monopoly in this period. And this is the glory days of Algeria in the U.S. market, 1979. Now, 1979, in this very city, the top seller of Algerian LNG, Nourdain Aitlaussine, stood in Houston and projected demand for 1990, and he said Algeria would be selling 45 million tons to the United States. All of you people forecasting an LNG renaissance, I just want to remind you, it's been forecast before, and it didn't happen. So it's always worth asking, is it going to collapse again? I don't think it is, but I think it's worth remembering that this was supposed to go like that. Nonetheless, this remains a small pie. So by the time we get here, where that red area is the capture of Trinidad, and everybody else is piling in to the show, we've got a lot more diversity for a very small pie. And, this is the total picture. In 2003, it finally gets above 10. Now, so on the one hand, I go along with all the things about the self-defeating Algerian policy. I do think they could have kept a share of this market without the aggressive policy of Nabi. On the other hand, let's face it, if you're going to have a dumb policy and you're going to target a market, why not go for a bigger one? So while they lost their monopoly in the US market, this is the Algerian share of the European market, which you will notice is substantially bigger. It also, however, begins to attract, this is just the LNG bit, by the way, a lot more diversity. And I still have sympathy with the hardliners in Algeria who exist today, who say, well, you can go off and be very flexible and give all sorts of deals, but frankly, I think I'll hold on to my very substantial piece of the action. I have sympathy with that. I don't think it's a black and white issue, though I do think they're beginning to lose. This could be eroded by that attitude. And this is where it's going to. The interesting thing is here, actually I was trying, yes, you see this is Spain. So Spain becomes the biggest LNG market in Europe, and this is after the pipelines arrive. So when the GME is finally economic, the Gazoduc Maghreb, going not via Almeria but via Morocco, which is an example of a gas peace pipeline, I would argue. They were at war before, and they're not anymore, and that doesn't stop them doing a bypass line. LNG kept rising. This is a paradox. The pipeline arrives, that's supposed to kick out LNG. LNG has continued to rise in Spain ever since the pipeline arrived. In fact, it's had a better share since the pipeline arrived than it ever had before. So that's the market. This is a situation into which the Trinidad shareholders came. Now, yesterday I maybe made it sound too easy. No group of partners hated each other more than the Trinidad partners when they put this together. They wasted no meeting, no opportunity to shout at each other, try to undermine each other, go behind each other's backs. And so this structure was actually agreed after they did their sales contract. And it's a reflection of that. But it's got lots of stress points in it. All of these points are sales points. There's sales from the upstream into the plant, sales FOB to the buyers. At least the buyers provided the ships, so there wasn't a sale into and out of the ships. But what it gives is a lot of flexibility to the buyers who have the ships. And also, this was the only part, really, that BG was doing other than owning the plant, because they didn't get production in the first train. However, because it was a company and had these shareholdings, it couldn't expand. It was a very rigid structure. It was a unitized selling venture, and therefore, as soon as it was obvious that they could take a bigger market, they couldn't move that quickly because they all had to squabble a bit longer. However, this flexibility given to the buyers, and I make the point in the paper here, there's a long note on it, I couldn't find it while I was sitting there. They gave the flexibility to Cabot and Energas because they thought that there would be a seasonal mismatch. Most of the gas, 60%, was going to go to Cabot in the summer. I mean, Cabot's was weighted towards the summer, not all of theirs in summer. And the 40% to Energas was going to be weighted towards the winter. At the time, that was considered to be, the high price would be in Spain in the winter, and there would be a lot of liquidity in the summer in Boston, and therefore you would be able to get the gas in even if the price was worse. As it turned out, the reason that they adopted the flexibility was an entirely different one. It moved by price, not by seasonality, and it moved towards the US. And this is a very dramatic chart, which shows this green line is the differential between Henry Hub and the Spanish gas price. And that is zero at this black line. So here's the price differential. Now, when you see the orange bars, the cargoes are going towards Spain. Because don't forget, Cabot could also redirect their cargoes towards Spain in agreement with Energas. When the price is a lot higher, as you expect, the blue bars, all the cargoes are going to the US. This had never been done in LNG before. This is a first in world LNG. This may be the pattern today. Everybody wants to do this now. But this broke the mold. Now, okay, it was invented by accident, but it was the kind of accident that everybody said, what a great idea. The only sad thing was the Trinidad sellers, all these cargoes moving to Spain gave lots of money to Gas Natural rather than to the Trinidad sellers, and so they decided next time around to try to get a little more piece of the action. Then they do Train 2-3 eventually. In your books, this shareholding is wrong, and I've since learned so is this. This is more like, this is exactly like the Train 4 one, the ownership. But you notice that now we've diversified production. We have a quasi-tolling agreement, meaning that they're actually still selling to the plant, but they tell the plant where to sell the gas. So even though it isn't a direct sell from, say, the BP and Repsol to the buyers that they chose, or BG to the buyers they chose, that is the way it's actually set up. So it's a sort of moving towards more flexibility for the sellers to place the gas where they want and do their own deals in the market. Again, this is not entirely unusual, but its intent is, because it's trying to make LNG less a unitized type of sale, less a project oriented sale. Now, we get to train 4, which from my story is slightly ahead of the chronology. And we have a pure tolling arrangement. Now, here, by the way, is the company that BP and Repsol have the upstream. And I should have said on train 2-3, Repsol farms into the BP upstream or comes into their company. And you think that was not part of the original train 1 flexibility of the buyers, give both buyers a share in the project. It was a separate deal done by BP and Amoco and Repsol, later taken over by BP, and there's a quid pro quo for that. That Repsol bought a lot of the train 2 supply and supported that going ahead. So here, though, these guys are selling to their customers, these guys are selling to theirs, and the rest are selling to theirs, and it's effectively branded LNG by now. So now we have buyer and seller flexibility. We have a lot of freedom to move the stuff around, and the project is an operating company, effectively. So we move on to my final slide, which I call the Trinidad Graduation Project. What have we learned? What we have learned is the original Train 1 structure was too rigid. It could not be easily expanded. It led to conflict amongst the partners. What about if we get it right from the beginning and make cookie-cutter expansion possible? So here is Train 1. Sell it all to Gaz de France, give these guys a share of Train 1. Actually, they also got a share of the operating company. A lot of local interest. These are the Egyptian companies. Here's ELNG. It's going to operate. It's going to own the common facilities, and it will run the train, even though the train is owned by this group up here. But basically, they have contracts amongst themselves. So you're going to add a train, have a long fight? No. Bunk, there comes the second train. Set up. Now, by coincidence, it has the same upstream, but it doesn't need to have. And we want to add another train. This has already been done, by the way. Rapid, bang, bang, bang. They also did cookie-cutter contracting. They went along to Bechtel and said, you know what you did in Trinidad? Just do it again. And, you know, don't get too expensive. Send us the bill. No messing around with dual feed and all that, but they'd been through that before. So it's a lot of automation in here, a lot of taking out of the complexity, contractual flexibility. So what do we do for a new one? Well, here's the theoretical new one. By the way, there's the train 2 ownership, separate. Oh, this is lovely. It all clicks in slowly. It's about that fast to do a new train, too, a few seconds. We can have a different upstream. We can have a different ownership of the train. We can have different buyers. And again, we have this operating company. They're going to run the train. Bang, 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 you keep doing it. That is the story of evolution of project structure and why I believe that Trinidad did break the mold and did open the way for flexible trading of LNG in the Pacific, and in the Atlantic. And as I said to LNG 13 in Seoul, a project coming to your home waters soon. This type of thing will be replicated around the world. Thank you.
Well, James, this was brilliant. You told them almost everything. There are a couple of things I still would try to keep for myself, but we'll talk about it in a while. The next presentation, where is he? Ken Medlock. He's a visiting professor of economics at Rice and energy consultant to the James Baker Institute of Public Policy. And I wish you good luck.
Thank you. There we go. Okay, yesterday, Peter Hartley introduced you, well, most of you, I guess, to the effort we've been undertaking here at Rice involving modeling world natural gas markets. And the effort began in some incarnation, I guess, a couple of years ago, as Amy Jaffe pointed out, but in its current incarnation really didn't get started on this effort until sometime last August, September. So it's still sort of in its infancy stages. Nevertheless, we have some very interesting results to share with you. The reason I point this out is because, you know, it's always important, I think, to caveat, unless you're going to go out there and bet $1 million on something, that these results are preliminary. And I'll just let you know that we are in the process of updating data constantly. And in fact, I'll point out a couple of issues that we need to address as I go through this presentation. Just by way of reintroduction, just a brief overview and motivation before I just sort of dive right into the results. As we all know, North America, until recently, experienced relatively low natural gas prices. And this, in fact, was the impetus for the growth in natural gas-fired generation capacity that we saw over the past few years, as has been pointed out by previous speakers in this conference. But things have changed, and they've changed fairly rapidly. And in fact, the projected tightness of the market, of the North American natural gas market, has led to people and corporations to actually look to future supplies for natural gas, in particular LNG. The other thing on the horizon, of course, is Alaska, and I'll address that in a minute too, because that is part of our simulations. Now, LNG can provide much of the needed supply. And the reason I have ... but really relates to the points that a lot of the speakers were making yesterday regarding education. North America must become a part of a larger marketplace. And absent education of the general public so that siting and permitting can proceed as it needs to, this will not happen. So that's something we need to be aware of. Now, this particular modeling effort is different in a lot of ways than other modeling efforts. In particular, I don't really need to go into too much detail because Peter did this rather nicely yesterday, but most North American natural gas efforts really just focus on North America, and they assume liquefied natural gas comes into the market at a particular cost and at a particular schedule. And this has obvious ramifications for what happens to price longer term in these particular types of projections. So what we're trying to do is actually incorporate the cost of developing each piece of the LNG value chain and look at the ramifications for that development on not only North America but the global marketplace as a whole. We've seen this picture about 100 times now, but I think it's a very important sort of lead into this. Now, before I jump into the results again, this is one of the data issues that we were discussing yesterday, as a matter of fact, and it revolves around gutter. The first point I want to make about the model itself is that a lot of people look at reserves, these are proven reserves, as evidence of what will happen in natural gas markets long term. And I think that is a mistake. It's not proven reserves long term that matter, it's potential resource that matters long term. Proven reserves is very important for the short and intermediate term, and that actually plays out in the modeling simulations. But the resource assessments that we have from the United States Geological Survey, which really give us a picture of potential resource, which then are proved into reserves that are then allowed to move into the marketplace, that picture is really what guides us through the next 30 years, then 40 years, and so on. Now, with regard to a data issue, we heard the Minister of Qatar yesterday speaking about 900 TCF in the North Field. Well, if you look at this particular cost of supply curve, which is actually data from the modeling simulation, from the model itself, you don't see 900 TCF in Qatar. Rather, you see something that's about a third of that. We have a sneaking suspicion, and I think we're right, although we have to confirm it with the USGS, that is largely because when the USGS does its resource assessments, they're looking at play level, they're looking at geologic data. And geological plays do not necessarily conform to international boundaries. So the data, the gas, the potential gas resource is in the model, it's just in the wrong place. In other words, it's actually in the Iranian reserve pool or resource pool. So that's an issue we need to get straightened out and incorporated into the model. But moving on from that, explain the experiments we ran. We ran a base case, and then we wanted to run a couple of experiments. And I call them experiments rather than scenarios because I think there is a difference. When we run an experiment, we're going to make a change in a single variable or a single aspect of the model and see what the implications are for the outcome. When we run a scenario, we're actually making multiple changes, not just a single change, because we're going to view a different state of the world, if you will. So in this particular experiment, we introduced technological change in the LNG business. We have falling cost of capital, so the fixed costs of constructing pieces of the liquefaction, shipping and regasification aspects of liquefied natural gas business decline over time. We use as a benchmark the rates of decline, or rates of technological change, if you will, that are in the World Energy Investment Outlook that was recently published by the International Energy Agency. And what you see when you move from roughly 2000 to 2040 is, in terms of the total cost of the entire chain, a reduction of about 40%, which is pretty staggering. And it has profound implications, actually, for the model results that I'll show you. The second experiment that we ran, we looked at Russia as a dominant producer. I'm going to, later in the presentation, refer to this case as the Russia monopoly case, but I want to note that I didn't really refer to them as a dominant producer here because we don't really know if this is the optimal monopoly outcome. In other words, what we've done is we've assumed a higher rate of return on all projects within Russia, supply projects within Russia, which will necessarily increase rents relative to the base case in which the required rate of return is lower. However, we don't know if this is the outcome that a monopoly producer or a dominant producer would actually, or the strategy they would actually follow, because we have to compare multiple different assumed higher rates of return to actually see where that revenue turns over, if you will. But nevertheless, we did run this case, and it has some interesting implications. Now, we'll jump right into comparing the cases. I'll start with Henry Hub. That's the point, the most liquid natural gas, most liquid hub where natural gas is traded in the entire world. And I start with this point because that's because most people are familiar with that particular location. The gray bar is the base case. And I've just represented averages across decades because it's a little bit easier to look at that way. From the gray, you see actually rising prices throughout the model time horizon. In fact, in the latter decade, the price at Henry Hub on average is a little over $5 per, I'm sorry, this is per MMBTU. I don't have the units on there. In the red bar, we have the case which I called Russia monopoly. So that's the case in which Russia is acting as a dominant producer. Prices are generally higher everywhere. Now, what does not necessarily come out in this picture, but will in others, is the fact that when Russia acts as a dominant producer, the impact on the marketplace is larger in East Asian markets than it is in the U.S. Okay? And I'll get to that in just a few minutes. And in the LNG technological change case, we see that prices are considerably lower across the board, actually. And in fact, we see from the Russia monopoly case to the LNG technological change case, in the very long term, a price differential between 50 and 70 cents, which is pretty significant. Regional price comparisons. So what we have here, what we're looking at here are, in the base case and the other two experiments, what happens to the price differentials to Henry Hub. So what we have plotted is the difference between the price in Japan and Henry Hub, the price in China, which is a weighted average price, I should note, because China actually has multiple regions, and Henry Hub, and Zeebrugge and Henry Hub in Belgium. So what we see in the base case is that there's a little bit more volatility in the price long term. And this is tied to the fact that Russian natural gas really saturates, if you will, the Chinese and European markets. And to do that, it moves via pipeline in the base case, not LNG. And these pipeline projects tend to come in bigger chunks, bigger slugs than LNG projects do. And so you get a little bit more wiggle in the price path. When you look at the other two cases, the one common theme across both of the other two cases is that LNG flow in general is larger in both of those cases. So more gas is floating, if you will, and moving to market that way. And what you in fact see is that prices tend to converge a bit more in those two cases. The differentials across regions are a little bit smaller. Okay. These particular two diagrams actually indicate the price difference within a region across cases. So what we're looking at, if we look at, say, the first chart, which is the Russian monopoly case, the gold bar is the price at Henry Hub, and it's the difference in that decade, that time frame, the average difference, of the price at Henry Hub in the Russian monopoly case as compared to the price at Henry Hub in the base case. Okay, so that's what we're looking at here. You see across the board prices are higher. And I can also note here that prices, if you look at the red bar in China, are significantly higher in the case in which Russia acts as a dominant producer. Okay. We also see that in Japan, and this is an interesting result, actually, I think. The price is significantly higher in the second decade, that's indicated here, but it's lower relative to the decade previous in the third decade. And you might wonder why. Well, that's because LNG flows are increased in the Russian monopoly case versus the base case. And so more of the Japanese market, in the case where Russia is acting a dominant producer, is satisfied via LNG rather than a pipeline from Sakhalin. Okay? That's the big difference there. Now, in the LNG technological change case, we see that prices across the board are generally lower. Okay? And in fact, you have pretty enormous impacts in Japan and at the Henry Hub. And that's because those two markets, in particular through the next 2 decades, are really the largest consumers of natural gas in the model. Okay? So when you lower the cost of natural gas, you're lowering a large proportion of their consumption, the cost of a large proportion of their consumption. Now, comparing the cases, we can also look at production share. What's happening across regions over time in terms of production within a region relative to the rest of the world. We see in the base case, Russia remains fairly constant. This is actually true throughout, well, it's true in this case and the LNG case, but it's not true in the Russian monopoly case, and we'll get to that in just a second. But in fact, what I don't have up here is the 2002 diagram, which is the year that the model actually begins. And the Russian production actually is fairly constant throughout the entire model time horizon in the base case in terms of share. Now, overall production, it grows rather dramatically. The two players that come into the market in terms of increasing their share in dramatic fashions across the board, but in different rates across different cases, are Saudi Arabia and Iran. Now, again, I'll caveat the Iranian finding with, I think some of that resource that we have in the model in Iran belongs in Qatar. So this will be revised. If we move to the LNG technological change case, we see that the Russian share, again, is fairly constant. But now the Saudi Arabian and Iranian share of total production has increased. If you look at the share, I'll go up, yeah. In the base case in Saudi Arabia, we're at 6.6%. In Iran, it's 12.5%. Goes to 8.5% and 14.1% when you lower the cost of LNG. That just makes supplies that have to move to market via LNG, it's easier for them to do so. It increases their returns, so the rents go up for these LNG producers. In the Russian monopoly case, you actually see through 2020 a share that declines from around 22 to 23% down to around 18% in terms of total production, and it rises slightly up to 19.2% from 2020 to 2040. But what's filling the void? What's coming into the fold? Well, actually, it's Australasia, Iran, and Saudi Arabia in the Russian monopoly case. So your major LNG producing centers really pick up the slack when Russia acts as a dominant producer. Okay. Now, this is, the point I was just making is really evident in this particular slide. What you see is LNG share of total world supply by region. So the blue is the Pacific Basin, the orange is the Middle East, and the purple is the Atlantic Basin. The big jump across all the cases in the purple around 2020 that you see there is Venezuela coming into the marketplace. Okay? And they come in pretty strong when they do. But what you can see, especially in the LNG technological change case and in the Russian monopoly case, is that the Middle Eastern share of world supply via LNG is larger than it is in the base case. And I think I have these all scaled the same so you can make a direct comparison. So. But again, it's worth reiterating. The point here is if you have a single large producer like Russia act as a dominant producer, there are other players that have appreciable enough gas resources that they will move them to market. In this particular case, it happens to be Middle Eastern LNG. These next three slides are not very interesting. It's consumption. It's the share of total demand within region. The only thing I want to point out here is that you have different price outcomes across the cases. So the total demand in the year 2040 is different across cases. Okay, and that's because we have price sensitivity in the model. Now, the one thing that does happen that does come out in these particular slides, it's the next two, which I'm going to scroll through fairly quickly, that does come out is that the shares are slightly different. In other words, remember I noted that the price impact is a little bit larger in certain regions than in others, given the particular case we're talking about. Well, that plays out because demand within those regions will grow at different rates if the price impacts are different. In particular, you see that in China, Japan, and South Korea, in the LNG technological change case, the share of total world demand in those countries is a little bit larger than it is in the other cases. Okay, so, and that's just to emphasize that point. Now, sort of a textual comparison. What I wanted to do here over the next three slides is basically go through some key results, if you will. This is by no means exhaustive. There is a lot of information in this model. Just to give you an idea of the scale, we have, and this is just pipelines, over 600 pipeline links in the model. So you can imagine when this thing actually sits down and starts cranking, it takes quite a bit of time. And in fact, it takes about 4 days to run the model we have right now. And that's on a dual processor machine, so hopefully you can get an appreciation for what we're doing, what we're dealing with. Nevertheless, I wanted to go through some fairly important findings that tie into some of the case studies. I point out Japan largely because that's sort of where this model conception began, if you will. The Baker Institute did a study, as a matter of fact, Peter Hartley and Bob Brito were involved in that, looking at Sakhalin options, pipeline versus LNG. And what they found in that study, and it's been confirmed here, is that is really a knife-edge outcome. Right? If you have prices move in one direction or the other, you can really end up favoring one project versus the other. You have cost change in a slight manner, you'll have one project favored over the other. Well, in fact, the same thing happens. If you see up here in the base case in 2010, a Sakhalin pipe is constructed, and it serves a pretty significant portion of the Japanese market. Now, in the model, no national grid is built in Japan. We have a regional representation of Japan. And so LNG still serves a significant portion of the Japanese market, but the Sakhalin pipe is constructed. In the LNG technological change case, where the cost of LNG movements actually go down, no Sakhalin pipe is built. So it's a complete reversal, which gives you an idea, to some extent, of what this model can tell you, right? If you want to assume something about technological change in one particular aspect of the natural gas business, it can completely change a set of results. So the commercial implications, I think, are enormous, but that's another issue. And then in the Russian monopoly case, the Sakhalin pipe is built and the market is served by both LNG and pipeline gas, but what I need to note here is in the case where Russia acts as a dominant producer, the pipeline that is constructed is not as large as in the base case. Okay? So pipeline gas does not take as large a share of the Japanese market in that case, but it still is constructed. Now, South Korea, this was interesting because of the various proposals to move gas into South Korea through North Korea, and so we allowed that option in the model. And the model on pure economics, where you don't have any political overrides in here, likes that option, and it wants to build that pipe. Now, in future scenarios, and there's actually one running on my machine right now, it's just not done. I was hoping it would be for this morning. We're not allowing that. We're introducing political overrides so we can see what the various outcomes in the model is. Okay. For China, And I need to note here, a lot of the differences for the rest of the way through this are not necessarily that the projects get reversed, but their timing is different. Okay, so the timing of certain projects will be different. And I also want to note that when I throw up a number like 2020, 2030, or 2035, something like that, in those years beyond 2015, the model is actually solving in 5-year increments. So these projects could be occurring in that window of time. What I'm doing is introducing you to the point at which the model is saying this is here. Okay? So it doesn't mean that a Sakhalin pipe is built in 2010, for example. It may have been built in 2009. All right? In the base case, Eastern Siberian gas flows down into North China in 2012, and in fact that is true across the board. Okay? It happens in every single case. LNG flows into South China in every single case. And that is true, happens across the board. The big difference is in the base case, a pipeline is built from Kazakhstan to Western China, and then it gets on the West-East pipeline, which is also constructed in the model. And that happens in about 2030 in the model outcome. In the case where you have LNG technological change in the LNG business, that pipe doesn't ever get built. And that's because more LNG flows into South China, and it pushes that gas back towards the west. All right, so that pipeline option never happens. In the case where Russia acts as a monopoly, the Kazakhstan to West China pipe does occur, but it occurs later. And the reason I've noted this here is because lower Russian production, because they're acting as a monopolist, will pull that supply rather than east, it will pull it west. Okay, that's what's happening in the model. Some other simple results. India, interesting. It really likes to build, and this is another political override that, that we've introduced in this other case that we're running, but it really likes to build a pipeline from Iran to India via Pakistan. On a purely economic basis, that is the preferred option. And in fact, it likes to serve India, the model does, with gas via pipeline. It does not build any LNG in the base case. It brings it from Bangladesh and it brings it from Iran, the largest chunk of coming from Iran. So it will be very interesting to look at the results with that particular political override, because it's going to make a huge difference for how the Indian gas market is served. But nevertheless, as you move through, you actually see that the only case in which LNG imports begin is the case in which the cost of LNG is falling, and it happens pretty far out into the time horizon of the model. In Russia, west to east pipeline is built in every single case. The timing is a little bit different. When I say west to east, that's connecting Western Siberian resources up to Eastern Siberian infrastructure that is moving into China. That is constructed in every single case. It's a little bit later in the monopoly case and in the technological change case. And that's because, as I said, in the technological change case, those markets that are served by both Russian pipe in the east and LNG are served by more LNG in the technological change case, which pushes back those pipeline supplies, if you will. Let's see, that was it. Oh, the other difference is the Barents Sea production will enter, according to the model, will enter LNG, the LNG trade in every case except for the Russian monopoly case. In that particular case, LNG is never exported through the Barents Sea. Okay. Venezuela, in all cases, exports begin, and I say 2020 here, it's sometime between 2016 and 2020. But that's when Venezuela comes into the market. And when they come in, it's, I will say this, and you saw that from the graphic that showed LNG imports as a share of total, or exports as a share of total supply. They come in with a vengeance. Venezuela, when it comes big. And that is, in fact, another political override that we're considering, is actually backing Venezuela out and seeing what happens to the Atlantic Basin in particular, and how hard will North America pull on North and West African supplies. This is I've only got 2 more slides. Let me just rip through these real quick. One I want to point out is in the LNG technological change case in the U.S., you have very aggressive growth in LNG. Do I believe this? No. But again, this is an experiment, right? We've only made one change. We haven't allowed technological change to occur in the extraction of resources domestically. Okay, so LNG is favored in this particular example. And what you see by 2035 is LNG imports into the United States are over 60% market share. So it's fairly aggressive. Now, again, it's an experiment. Do I believe this? No. But the point is, and that's my distinction between experiments and scenarios, we're making a single change here. Future work, just so you know, I've sort of hinted at all of this stuff already. We're continually updating infrastructure and data because new information comes available on a weekly basis. And so, this thing will continue to evolve. This project will continue to evolve. As far as technological change, what we've considered doing is taking the NPC's assumptions on technological change for resource production and implementing those into the model. Because right now, we're in a static technological change world as far as resource production goes. And then we've got various scenarios and experiments that we'd like to run and look to outside guidance on how we might actually proceed with that. And that's it. Thank you.
Well, Ken, thanks very much. I kept sending you signs, but what you said was so interesting. I guess I would have liked to listen to more. But that being said, we are about 15 minutes behind schedule. What we're going to do, we're going to have a short break anyways. I would like to ask you to try to keep it to maximum 15 minutes, please. We'll try to call you back in about 10 minutes, and then we will proceed with our panel of experts. The questions will be reserved as a group to the entire group at the end of the session. Thank you.